Want my latest market insights? My latest report, Recession into All-Time Highs, is now available. Scan this QR code or click on the link in the description. Hey, greetings all, and welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading, joined by Hans Albrecht, our options mentor in our LaDuc trading service, where we are sizing up macro as well as obviously the trades that support it, but also lots and lots of market structure. And I'm talking options. So from his wonderful courses that folks use to actually learn option tactics to protection portfolio and the like, we've also got some geopolitical risk that is starting to escalate in, oh goodness, Eastern Europe. So there's kind of one eye open. Also Japanese elections this weekend for new LDP leader, which may in fact trigger a little bit of volatility in the yen, which is always another eye open. But ultimately, the market is still running higher despite government shutdown, which is on again, off again, but sort of kicking the can, but sort of also a big risk for an extended shutdown, and what that means for data. In other words, we're getting announcements that we may not have non-farm payroll data or CPI data on the 15th, so this Friday or in a few weeks from now. And then earnings kick off, and we'll be talking about how to play running into earnings, and then also how rambunctious will this earnings season be after Q2 just hit the cover off the ball, so to speak. So we have a lot of concentration risk still in the market, and a market that's pushing higher. And we have precious metals and other metals, but basically industrial and copper, but also silver and gold are manifesting this macro event risk. So we got a lot to talk about. Sector rotation, stock selection, what are you trading now type of thing. And it is an Ask Us Anything format. So hit us up in chat or Zoom Q&A as you like, and we will monitor your questions as well. So anyway, we didn't do it last week. I was out of town, but I'm back and got my sea legs. As you know, I post in our Slack client workspace, and I did a few of them last week. So one of them is Tesla. I know that you're very bullish. I've had Tesla 280 on my radar, but we also have some shorts that have been working. Reversion to the mean, Oracle and Google. We also have consumer lending getting hit, the SoFis and the buy now, pay later contingency. That is representative of the slowing real economy relative to the Wall Street AI ecosystem. So we'll talk about that as well. But otherwise, we got some very strong sector rotations that are still in place as it relates to things. Uranium, copper, gold, silver, that are very, very instrumental for both themes, de-dollarization and AI electrification. So let's turn it over. Basically, Hans, let me know what you have been looking at the past week or two since we last got together and did this. And thanks everyone for being patient and waiting for us.
Yes. Thank you everyone for coming. It's been interesting. I think every time you think things are going to have a little pause here, then they just kind of keep going. The S&P has just been very strong. We've seen a little bit of weakness in some mag stocks, and yet almost incredibly, Tesla is finally taking the baton on the side of mags and picking up on the story, right? So Tesla's a story stock. It's obviously not a value stock. This is not something that trades at a compelling valuation like an Nvidia or Google. But the reality of it is that we have a little bit of two kinds of markets here, which is one very story driven. We're seeing parabolas. We're seeing some parabolas come back down, but a lot of my indicators are showing that the parabola market is still very much intact. So even though we see parabolas reversing a little bit in some areas like an Oklo, we are seeing things continue to pick up in other areas. So I think it's safe to say that we're still in this sort of mania phase, but at the same time, we're also seeing a little bit of a pause. I said a couple of weeks ago, I said, maybe we get a pause in mag as we start to broaden out a little bit. And we are starting to sort of see that play out a little bit and looking at things that may actually start to improve over time. So it's a very, very interesting area. You've got those non-negotiable areas, as you were just talking about. I think rare earths and some areas are going to be nuclear, perhaps some power type areas that are going to be non-negotiable in a sense, because I believe that there's a sense of urgency from the government's perspective. Whoever's sort of driving the truck over there is saying, listen, this is going to be a problem. There aren't going to be enough of these. I mean, if you look at these orders from Oracle and across the board, there isn't going to be enough of everything. So I think commodities are actually maybe kind of an interesting place to be over time, because as this build out continues, we could see some pressure, some supply chain issues, a shortage of certain things, and perhaps some governments not playing as nice. If China has a lot of power in that sense, so maybe at some point they say, well, no rare earths for you. And so I think there's that sense of urgency, and that's why we're seeing the USARs and what was the other one, MP, doing well. And then, of course, Intel as well. Everyone screamed at me, you're an idiot for picking Intel in the low 20s. And I said, well, okay, let's see, because it's not about liking Intel. It's not about thinking Intel is going to be the next Nvidia or that they're very competent. They're the complete opposite. They're utterly incompetent, but they are in an area that is non-negotiable. When you have all your chips made 80 miles off the coast of China, this becomes non-negotiable in a worldwide build out. So there are all these very interesting things kind of playing out. We're seeing software. I kind of like software a little bit. I was wrong. Look, Adobe, Salesforce kind of not acting very well. So maybe that theme is back in play again, where it's AI is going to mow the lawn of some of these companies. So a very interesting environment, Samantha, with disruption everywhere you look. And it's absolutely fascinating. But for now, it's clearly just to the upside. We got rid of that collar strike, which is really, it was of no consequence this week, down around 65.05. It had really no effect on anything at this point. It could have served as a little bit of support if we'd come down towards that, which we did a few times in 6,600, a little bit lower. At this point, they've moved it up to the upside, and there's a little bit thicker gamma as we move up. So it's a little bit more difficult for the market to kind of chew through that upside. But that's sort of where we're at. And sentiment just really not that great. So it's a strange market. I don't know if you watch many of the sentiment indicators, but it's very strange for markets to be kind of all-time highs with a number of sentiment indicators being rather poor in some cases. And I sense that speaks to a bifurcation that could be happening between Wall Street and Main Street, because some people are not doing well. There's a part of the economy that is in recession, and there's a part of the economy that is creating new billionaires on a weekly basis. So here's our world.
Well, my rant is this. I'll share it. It's kind of on repeat. So this is our Slack client workspace. And basically this Look Mom 6955 is basically referring to that JP Morgan collar that just got rolled on September 30th, yesterday. And it is interesting because a while back when I gave this update, SPX can easily move into 6,500 as long as this support holds. At the time, obviously, we were just getting above it. Otherwise, big picture, it can continue into 7,000, even 8,200 in time. Now, that was back in early July. So the point is overbought can stay overbought. And sure enough, this little line here, you can't see it very well, but it says 69.50. That's a fib level you throw on. And wouldn't you know, JP Morgan comes in with their spread, and it is the $69.55 call. So they have moved up and they are selling the call against a large put spread into end of year. And it's just interesting that it happens to be the same fib level. So 69.50, 69.55, same difference. Look, Mom. Yeah. Now, the rant that I keep having live in my trading room is basically the same, which is, it's on repeat. The market keeps moving higher. It's on repeat. Corporate buyback, blackout, we know about. It's about 95%, give or take, depending on who you're following, right straight through until the October 24th. CTAs, which we've talked about repeatedly, still have not sold. Why? Because they don't have a reason to. We need a macro trigger. And believe it or not, government shutdown risk is absolutely a trigger, but only if it lasts more than a week. And in the meantime, I keep saying breadth is starting to soften, but it hasn't rolled over. You don't short all-time highs, you don't buy all-time lows, but the point is liquidity is still solid. And as long as there is buying, it is something that's very hard to get in front of and sell. I also have the growth value ratio that we look at every time we do this because it's very telling. We're still in a growth rotation. Is it forming a pattern of reversal? It's getting closer for sure. US yields, dollar, oil, they're all chopping sideways. And what I call sideways, people get very zoomed in on a very short duration, but big picture, we are still in this kind of 65 handle for crude. Dollar is sitting on 98. 10-year yield is above 4%. We got really a Goldilocks kind of equity zone between 4 and 4.5%. Anything below starts to get a little iffy. Anything above will definitely get a lot more iffy. And then, of course, the narrative. You were talking about sentiment indicators. The bull market rationalizing of bubble-like valuations. I write about that a lot, but it's not a reason to short. And then last but not least, we have definitely seen Volmageddon hedges, and I wrote about this. They're rolling in for year end. They're positioned in March, and they are definitely lower. So that's one thing. And gold skew is just clearly in play, macro risks down the road. So that's it. In general, I just keep kind of pushing on this theme that we're still moving up. And in fact, 67.13 is a level that I gave yesterday. It's now 68.05. So we have a situation where everyone is kind of exhausted by the bull run. I don't think it's hated. It's got no reason right now, even with our bifurcated K-shaped economy, which I have also written about that a lot, which is we've got a situation, no question. And I know you and I have talked about this, but this is a very different backdrop now. Consumer lending sector started rolling over last week when the ABS, the lending Tricolor and First brands went belly up last week and again just a few days ago. And then basically this is really creating some initial tremors in the credit markets. So I would contend falling credit quality trumps falling credit spreads. Everyone's looking at the tightness of credit spreads, but we absolutely have a situation where this is affecting the lower to middle income consumers from real personal consumption growth. It's expected to decelerate. We've got households. Anyway, I put a whole bunch of data in here, and Jeffrey has been on this very, very front and center as it relates to the weakening situation. BIS, for those who actually follow big macro tells of BIS, has been warning. Fitch also came out just yesterday and started warning. So the whole ecosystem yesterday was kind of upset on the First brand's bankruptcy, but it also hit regional banks, and major banks even started to soften. So Fitch came out with a warning, interestingly enough, about the private credit market, which is small, relatively speaking, but it can be kind of the first pressure that then causes credit spreads to widen and then the hedge funds to unwind their U.S. Treasury shorts and their Mag 7, Mag 10 long. That is a pair trade where they're extremely short bonds and then very, very long the VIP stocks. And so when they start to unwind that, you start to get higher yields. And then, of course, the higher yields lead to higher cost of financing, higher term premia, and then you start to get volatility finally. Right now, we do not have FX currency volatility. We don't have treasury volatility. We don't have equity volatility. When you get a fundamental or a macro trigger, like war breaking out is also a gray or worse swan, but the point is then you have a reason for volatility. But the weakening of what's happening in the market underneath is still a tell that the consumer is definitely not as well as on Main Street as Wall Street. So we have some massive, just to kind of end the rant, we have some massive concentration risk that is making this bull train chug along on the track, and it takes a few miles because it's fully loaded, right? You can't just stop a train on a dime. It takes miles for it to come to a stop. In the meantime, we haven't stopped. We're still going up. But kind of consider this. The top 10 holdings in the S&P make up 39% of the index, the highest concentration on record, and the world's 7 largest companies are all U.S. tech giants, which is why folks are passive income still goes that way. But as unemployment starts to pick up, and it is, and it will continue to pick up, this will hit the passive investing. This will hit margin debt. This will hit disposable income. This will hit selling, believe it or not, of equities. And long story short, we've got 22 of the top 25 companies in the world are American. So long story short, we definitely have volatility that's coming in, but we have timing it is the tough part. And I will continue to kind of bang on this drum that we have moved into this inflationary world that isn't being priced in, monetary inflation. And even Michael Howell was out this week saying large-scale monetary inflation is underway as a result of fiscal dominance, something I keep talking about. Investors face a future of world of monetary inflation, not financial repression. And financial repression is what we're really excited about on Wall Street. Keep and suppress rate volatility, equity volatility, and currency volatility. And so when that starts to change, and we need a reason for it, is when we start to have equities repriced. And right now we do not have, we got the tipping point, but we don't have the employment or the inflation data to cause it to roll over. So that's it. That was the explanation that I'm giving as it relates to the difference between the Wall Street, let's trade whatever's moving. And there's so much going on. It's awesome. From metals, not just related to data centers, but also themes like AI software, all the way through to the debasement and devaluation of the dollar keeps also the market looking a lot healthier. But honestly, it's still just monetary inflation. It's unfortunately not really a great backdrop for a sustainable economic growth backdrop advance. So we'll see what happens. We'll see, obviously, as we get into Q4, what looks better, what looks worse. But right now, there's no question we still have concentration risk, and that's driving the show.
Yeah. And I mean, look, the concentration risk, I mean, I think it's very warranted. I mean, they make most of the money. That doesn't concern me so much. It kind of reminds me of April when everyone was saying, well, it's the end of US exceptionalism. And I'm on the record saying these guys are going to be proven very wrong saying that. The US is absolutely in control. Maybe that changes over time. Maybe we see some improvements coming from China. But I said they're going to regret. And sure enough, April was the big month of foreign selling. And ever since then, it has been buy, 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 buy. I said they are dummies and they're going to come right back again because you cannot argue with who is really driving the tech bus at this point. Don't know if that changes. I really doubt it does. Some of those main players in the US are just absolutely too powerful. It does not matter if Baba comes out with a model that is 3% better than one of the US tech names. That is not what this is about. It is about how this works its way into consumerism, into ecosystems, a la Google, a la Microsoft, into everyone's productivity and workflow, et cetera. It really doesn't have to do with all that other stuff. So that doesn't concern me so much. But what I think the market might be picking up on is, and you're absolutely right, Samantha, that this has to happen. This cannot just be AI. It does have, there's potential there for an infrastructure build out. There's going to be physical construction. There's going to be a need for people who are skilled in certain areas, but things cannot continue without a broadening. And I think the hope, and this is the Hail Mary, is that really we're at a point where we need good earnings and we need that to translate into a broader economic benefit. And the idea is that I sort of looked at this week and I said, you look at the 90s and you say, well, okay, what happened in the 90s? Well, the internet came along. And what was the internet? Well, it was just kind of everybody getting online. You had to get them on their services. You had to get them a computer if they didn't have one. Because if you remember, computers weren't that great. I remember the Amiga and all those ones. So you had to get people involved and then on the internet. And then voila, they have all access to all this wonderful information and then e-commerce and all. And so the big companies at that point were really just kind of setting the stage for the next couple of decades of social media, of e-commerce, of various ways that the internet brought benefits to us and a lot of negatives, I might add, when I look at my kids who can't get their eyes off their phone. So, but this is going to be an interesting stage. I showed this recently and I showed profit margins, fantastic from the big caps. They've had their run now. They're getting expensive. By no means, I mean, Nvidia's cheap, Google's cheap. There are some cheap stocks out there and they're going to do well because they're simply in the right place and they control so much. But having said that, they're quite expensive as you compare them to some of the exuberant periods that we've been in. The whole idea is that what they have created, as in the scenario that I gave you in the 90s, which was building for the next decades after that, is they have now built for this inference stage. And inference is going to be that sort of moving throughout the economy. And we hope, we don't know, some people can't figure it out, a la MIT study, which was kind of stupid, but we're going to have to figure this out. How do we help? And we're already seeing productivity by some measures really starting to go, but jobs really not going with them. If you look at 2021, the tech productivity, et cetera, went bananas, but it also came with hiring a whole bunch of people. This is a new world where you can achieve some of those things without hiring people. And that's going to be a problem at some point. But the idea is that this eventually will spread. I think that's part of what the market is hoping for, is this is going to spread to, if I may, small cap or medium cap or some of these businesses that have been sort of, in a sense, forgotten because it's all been about MAG and it's all been about those amazing results from the Nvidias and everybody else building this new stage. So the idea is that that stage now has benefits to the rest of the economy. That is going to be the savior for the economy at some point. But a lot of things have to go right. We don't know how long that's going to take, but I think there's a little bit of that hope there. So you've seen the IWM move up. I picked up some out of the money calls today and some in the money calls, thinking that, okay, this is one of those areas. I'm always trying to think of, okay, where are people kind of getting this a little bit wrong? And I think it's worth a bet as I start to see those profits curl up in those smaller industries. So the hope is that, okay, this is where maybe the baton is passed to the rest of the economy. I'm curious to hear your views on that, but it's something that we're not going to see right away. But the market, of course, is going to prognosticate and price that in a little bit earlier. But for now, more broadly in the economy, I mean, I don't know if you saw Torsten Slok. I mean, this is stuff I've been saying for a while. You look at retail sales, you look at the GDP numbers. I know the GDP isn't reflective of everyone anymore. It's no longer reflective of people and regular folks like it was 50 years ago, maybe. You look at credit, bankruptcy filings coming down, down, business formation going up, all kinds of positive data points. It's very difficult for a bear to really hang their hat on anything at this point, apart from, okay, we're technically overbought. Consumer confidence actually starting to improve by some measures over here. Consumer expectations for business conditions improving. I'm looking at these charts and they're all heading in the right direction. Are they going to be wrong? Well, maybe, but if you're fighting this, if you're fighting a positive backdrop with rates actually coming down and AI starting to juice everything, it's a very difficult thing. You're right. It's going to take one thing that potentially drives down a Palantir by 30%, like in an instant. But right now, nobody can see it. And it doesn't mean it's not going to happen, but nobody can see it because it's all gas and no brakes.
Well, again, this is our respective take on the market, which is mine is this is all policy intervention that comes in and supports, including tariffs, by the way. This is absolutely preordained, for lack of a better word, meaning I wrote about this. The dollar would be devalued, which would give much, and the more it's devalued, the more tariffs he will actually raise. And this is working. That's also a big, big tailwind for equities. And then, of course, the AI ecosystem, which is for sure has its foibles. But for right now, this is the narrative. And so we go with it. It's a growth rotation. Value as a sector that now outperforms. Technically speaking, small caps, IWM, Russell 2000 are back up to their all-time highs, 52-week highs, whatever, but they still haven't broken out. And that's what everyone is banking on. That's what folks have been talking about for years. But 43% of the components are still unprofitable and at risk of this bifurcated economy, which is Main Street not doing so well, but those who have high earning incomes are, and that will, of course, balance out later as unemployment rises with inflation. So cannot be too bullish, but technically there's tactically bullish reasons price keeps moving up. But as it relates to the other side of this, which is investment, that's being done right now is the promise of U.S. government as venture capitalist. So that's why Intel will continue to get a bid. That's why Micron continues to get a bid. In fact, I did a segment on this the other day where I was talking about this. I talk about it a lot, but the point is, here's number 2, U.S. government as venture capitalist beyond MP, which is rare earth, which got a 40% Department of Defense contract. And besides UUUU, which was recommended on July 10th, the same day MP got the 40% investment, and it's up 153% from that recommendation because that's where I thought they would go next. There's always a trading theme. Why Intel? It was absolutely. It's up again after hours because they're approaching AMD. They're approaching everybody. We need investors and the government has our back. So of course, how can you fight the largest whale that there is? So we've got Intel and Micron still will be in play. And then there are some smaller plays, SKYT and GFS. You can look them up. But the point is, Global Foundries. So these are plays that I would not normally recommend, but I'm saying keep them on your radar because they have to do with fabrication. And the U.S. is now the biggest venture capitalist out there outside of the Saudi fund. And by the way, one of these is United Emirates. I think it's this one. Anyway, you got, of course, Raytheon, LMT, the defense contractors. You've got drone players. You've got the Secretary of Energy coming out and saying, yes, we're going to invest in uranium. So, of course, these have been recommended since November of 2020 in my trend long list. Now they look like momentum stocks. It's ridiculous. But the point is that this is a very different market. So we have this AI narrative, which is driving Capex build out on top of policy intervention by Trump, who is absolutely focused on equity returns and tax receipts. At the same time, we have a lot of finagling of Fed and Treasury intervention, which makes it all look very sus, but we can't do anything about that. We just know that their intention is to keep things going and to obscure data that's bad, like removing BLS payroll data and or CPI inflation data likely on the 15th. So basically, we can put blinders on and just trade whatever's in front of us, but to be complacent, I still think is dumb. And I think that ignoring geopolitical risk is really dumb because we don't know if there will be a surprise. So just have that mindset of this could be 1999 to 2000 for sure. This could be the next bullish secular market because folks are so excited about AI, or we could actually be getting some really, really soft prints coming in for growth and higher unemployment and higher inflation, and then equities need to be re-rated.
Well, that's the one sort of, as I look at my base cases, it's a little bit boring because it's sort of been the same for quite a long time now, which is just what we've been talking about, up, up, up. And this being bigger than people realize and people comparing it to .com, which is like, you got to be kidding me. And so I'm not saying that's not going to happen on some stocks. We've seen some silly stocks and they're going to do that. And I think there's going to be more to come. I think there are going to be some very, very fantastical moves from stocks that, I mean, the best ones are the ones that don't really make any money. You can point to a company that makes money and go, well, okay, the AI is going to help them 3%. And so you can kind of extrapolate and figure out, okay, but Tesla, I don't know, what are they going to do? I mean, the sky's the limit for power blocks and their power. People don't even talk about the power side of their business. It's humanoids and sometimes cars, which is showing some signs of perhaps coming back a little bit. But it's that sort of, I think, the kind of ace up the sleeve. And so these stories kind of have all kinds of potential from a trading standpoint, which is fun because we don't know what they're supposed to be worth. And those are the most fun things to trade because they can go parabolic. And for me as an option trader, that could look ridiculous when you start looking at how the vol will react and skew and things like that. So those are the most fun. And then you have the more sort of dependable things. And I'm certainly playing the Googles and MUs and things like that trade at more reasonable valuations. And I think those are good stories from value standpoint relative to an AVGO. So there's sort of those pair type plays there. And then financials, which are good. Goldman's done well. It's kind of a little bit soft lately, but I think there's some nice things potentially. I mean, if you think about the companies that can really put AI to use very, very quickly, finance companies, that's kind of sort of the low hanging fruit. But having said that, as I started off, this part is I said, I always have to kind of look at where I think the durability is. My mind has not changed in many areas, but I am starting to kind of revise my view of inflation because as I said, probably last week, I said, well, you kind of can't have everything. You can't just have like a roaring 20s and this massive build out and things sort of spreading to other areas of the economy. You're going to have wage pressures. There's no question about that, but inflation may be just a little bit stickier than we think over time. Now, can the market handle that? Well, if it's strong growth with a certain amount of inflation, yes. If it's 2021 inflation, then no, that's going to be a problem. And so remains to be seen if we do have supply shortages and critical elements and critical inputs into this build out of infrastructure. That could be one of those sort of mini swans in there somewhere when one of these tech companies comes out and says, we'd love to sell X amount, but we can't get the inputs necessary. It's a good problem to have, but it also is going to affect earnings in a way. It's not a good problem to have, but we have so much demand. That's the good part of it, but we can't fulfill it. And so there may be something like that kind of rears its ugly head at some point. But yeah, the inflationary part, maybe a little stickier, I've come to sort of realize, but October still looks like a pretty high chance of another cut though, Samantha. I think we're sort of heading towards 90%. I don't know, last I looked on the CME.
Yeah, it's still all relevant though, as it relates to inflation data or not, whether we get it. Lisa Cook was allowed to stay on the board until the Supreme Court can hear the case in January. And sorry about that, but my camera obviously gave out. I see some questions about bullish China and all that jazz. So let's just show a few things and then get on with some of these Q&A questions. But rate cuts being priced in or out, as you know, I'm still bull steepener gal. I said in December 2024, I see it moving into plus 90 positive basis points, and we're still in the 50, has not spiked above, and 64 basis points. That's when it really starts to get busy. I am still a bond bear, a currency bear. You just can't talk me out of that, except for a trade. And we could get a rotation into bonds, into like we did a little bit for pensions, for example. Now we've got Treasury yielding more than the stock market, so there could be some more rebalancing. There could also be recession risk pulled forward on a nasty print of employment, which I'm expecting in the near future once we get real data again. But the point is they can get a bid, but they're not going to sustain. They're not a safe bet for longer duration notes and bonds. So I'm still bearish the currency, bearish bonds, and equities are this debasement, devaluation trade. So, of course, until we can get the rate of change in the dollar movement to interrupt that flow, meaning if it starts to dump aggressively, the US dollar, then all bets are off. And that will very much show that money is going home again. So we have this interplay, but right now, long story short, I am still bullish the China rotation. So this is something I've talked about for a while, and this is intermarket analysis that I posted for clients, and I've been very bullish BABA since 68 last year, and we timed the October parabola and then again into March, and then it reset. And basically in July, I said, yeah, I'm still very, very bullish China. JD has not taken off yet, so that's a high conviction long. A parabola can result in the Shanghai, Hang Seng, all that. And lots of plays over there are getting found, whether it be miners, whether it be AI, or your Chinese ADRs like Baba and Baidu that went hot fire flames, very long and strong. Baidu from 90 into 136, and now it's basing around there. Baba from 78 into 182, and that's quarterly resistance. JD hasn't even taken off yet. So to answer your question, yes. High yield credit spreads have not started to move higher, but the quality of the spreads is falling, but the NASDAQ is still bullish. Gold consolidating, as I wrote in July, ready for its next push higher. And you know what's happened to gold, 3,900 continuous. We've got silver, 14-year high. We've got palladium, platinum. All of these are extremely good. In fact, this is from what? It's up 47% GDX from this very high conviction trade setup for the miners, silver, gold. It's incredible. Palladium also started to pick up very strong. I gave a recommendation on PLG and it's up 33% since. BTU is coal. That went hot fire flames. In fact, speaking of government intervention, they just announced that they're going to give a few $100 million in support and 13 million acres of federal land opening for coal leasing. We've got tons and tons of stuff that is still working, from tech, AI, software plays, to China, to the NASDAQ, to gold, etc. But all good things do need to come and take a little pause. And I think October will be an interesting time for gold and silver, because I can see that there's a question here about backwardation and all that jazz and how will it affect silver. I have a different set of tools, so let me just kind of address that. This is a tool that I've used really well in timing this rotation in gold and miners, and it's a bullish percent index. So this is an intermarket analysis. And several months ago, I said that this bullish percent index in gold miners, now remember it's up 50% since, could last for weeks to months. This is just one tell. Now, if I go back in time, and by the way, this particular indicator can't get above 100 and it can't fall below 0. The last time it triggered 0 was in August of 2015. The last time it triggered 100 was in August of 2020, which, by the way, did mark a top for both bonds and gold at the time. Long story short, it is a very good oscillator for telling when things are oversold or overbought. And 100 does not mean, as the market can stay overbought, so can this indicator. But in October, I don't know if you've noticed, is when back in 2016, we did get some pullback. And this is again on a big picture. I'm going all the way back to 2015. And I'm just telling you October of 2020. We also got a pullback in the precious metals complex. We're approaching October. We're in basically a parabola. Does this signal a short? No. All I'm saying is it would not surprise that we have a dollar bounce and a precious metal pullback in October, and that likely could also introduce some equity volatility, because when we have FX volatility, it seeps over into equity volatility. So does that mean it's a fait accompli that we're going to have a pullback in precious metals in October? No, but I'm looking for it. I'm looking for a pattern. I'm looking for a macro trigger. And then, by the way, of course, I do think it would get bid back up. But for now, it is just a warning that October could see a dollar bounce, some precious metal pullback, and then we'll see what happens with equities. But right now, we're clearly above my 6666. We pushed into the target I gave yesterday of 6713 SPX. Now the new one is 6805. It's still bullish until we have a reason not to be.
And I think a lot of people are desperately waiting for some sort of pullback from a fund manager standpoint. I mean, we've seen the hedge fund flows have been very, very strong. So the hedge funds have sort of gotten back in again after sort of getting it very wrong in April, May, and perhaps June. They've been sort of piling back in. So that may be a sign of, as we know, the systematic strategies are kind of all in, basically. Hedge funds are all in. Retail's maybe a little bit skeptical at this point. So we're at that point where I think people are waiting for earnings. Are the earnings going to be good? Are they going to be good again? Because we need some sort of, if S&P is going to start to push 300 plus on the earnings side, then that's what we kind of need at this point. So the sort of the flows money, a lot of people were wrong money has come back. The systematic money has come back. So now we're kind of at that point where we sort of need to see, that's where the rubber hits the road, as they say, and we better start to see some results. But I think a lot of people I was listening to Kalanovic the other day, and I was like, oh my God, this guy really I don't know his whole history, but wow, he was going on about how there's this reason, that reason, all these reasons to be bearish. And then he goes, but if we get a 5% sell off, then, I'll change my mind. So I said, I was thinking, there are all these bearish reasons, all this macro stuff, all this crazy stuff. You're so bearish on this and that and this. But if you get a 5% pullback in the market, then you're going to reevaluate that. So what? You're basically a trader like the rest of us. What are you talking about? 5% lower in the S&P and suddenly it's fantastic value and all the stuff that you thought is out the window. Okay, I get it. You're a trader like the rest of us. And I think there are a lot of people in that position going, wow, boy, God, if you just give me that 5 to 10% sell off, I promise you I will get back in. So, but look, that's part of manias as well. I'm not saying things are wonderfully valued up here. I think there are a lot of people who've been sort of waiting, and we got zero seasonality. I mean, zero. If you look at the seasonality, we're just like, it went, nope, sorry, went right by the seasonality and said, we don't give a crap. And the market just kept going. So we've blown that out of the water. So any of these people, these fund managers who are like, well, I'm going to wait for September and early October to get back in, they have not gotten back in. So now we're at the point where you're starting to see some improvements. I pointed out a whole bunch of them earlier. We're going to give in a very strong seasonal period once we get past that first half of October. And if you get all these people doing the exact same thing they did in August and September, and now they're going, well, please give me a pullback, and it doesn't happen. Well, we know what happens into Christmas. No guarantees, but generally that is an extremely positive period. Fundamentals aside, it's a very positive period. So here we are. This is what it's all about. It's hard. Like, I will admit, as bullish as I generally am, it's not easy to put on new, very bullish positions when you sort of see this straight line sort of thing. I am a trader. A lot of my history is trading. I like to see a little bit of two-way action once in a while, not just straight up all the time. So it's a challenge from that standpoint, but some long-term holdings in the right accounts, I'm just like, okay, forget about it. I think things could keep going from this stage on because there's still a lot of positives out there.
On the Micron front, and I can show you a chart, but basically I've got 190 as an upside, and then it should absolutely see some digestion. So Micron is also kind of strategically important. And I know lots of clients are chasing this positioned, actually, that's the wrong word. They were positioned swing long, and now it's getting chased. So just kind of take care up at that kind of 190 area. That is definitely some resistance level.
Micron's cheap. Micron's cheap. It's cheap, and it's in all the right places, and people are underestimating the need for what they do, the DRAMs, the DRAMs, the memory side of things. So they're just kind of going, and they have that nice US has got to win sort of narrative as well. But Broadcom's very expensive. Micron's cheap. Nvidia's cheap. As much as people are like, well, Nvidia's kind of overvalued, but trading below its 10-day average from a price earnings basis. So there are some interesting things. This is not Cisco trading at 100 times earnings in 1999 or 2000. Like, these things trade okay. Now there's that other side of the coin, which is, well, when is this Capex going to slow down? If a company has like three customers, if that slows down, that's probably why they're not priced. If they had a really nice, broad, beautiful consumer base, then it'd be a little bit different. But it's hyperscalers. There are a lot of people who sort of are spending the money. OpenAI is just going bananas, spending money. I don't know where it's going to all come from, but I suppose in the manias, they're just going to find it from all left, right, and center. So this is part of the mania, but it is building out something that is nonstop. I mean, it's just, inference is nonstop, and that's why you just need that nonstop infrastructure. We do have a question in here, Hans, with your directional plays. What do you do in the midst of a bullish market? Well, it's funny. I had a tweet go kind of viral for me, which isn't that many, and I said, cover calls. You look at cover calls, and it's the same thing for put selling. Puts have sort of that nicer edge. There's a positive edge out of the money put selling in general because you have that nice steep skew. And so occasionally I'll put out a tweet like this, knowing that it's going to sort of touch a nerve. And I said, this is not free money, because some people say, well, cover calls is like renting out your house. No, it isn't, because when you rent out your house, you are not limiting the upside value to your house. Your house can continue to appreciate. It is a very, very different situation. That caused problems. It caused people to get upset about it. I said, listen, it's not that I don't like them. I will do them, but you have to be very strategic about them. It has to be worthwhile. So this is a market, Richard, where things are just very, very strong, and the option selling side of things things, especially the call side, has been challenging. Selling the upside calls generally is a very, very thin edge to negative edge trade, just statistically backed by that. People can argue with me all day long. It's statistically backed. And I know anecdotally, statistically, I've said it on here before, one of the best pro trades is buying upside when you're in the midst of a very kind of calm to up market. It's just cheap. Now we're getting to that point where we are seeing vols pick up. I said 6 weeks, 7 weeks ago, I said they're too cheap. Long-term vols are too cheap. They've gone up. I said upside call skis too cheap. Boom, it's absolutely soared. So now we're at a place where I don't think it's exuberant what I'm seeing in volatility markets, but it is not the easy pickings that were there, say 5 weeks ago or 4 weeks ago. So now we're starting to play a little bit more call spreads. You have to use that skew to your advantage. You're not just buying some out of the money calls because they're expensive. And if for some reason the market just kind of goes quiet for a couple of months, who knows, or we find a top or some news comes out and it's a reason for the market to kind of come down and sit around for a bit, then you're going to get hurt. You're going to get vega'd, which means you're going to have the fact that you bought those expensive options, they're going to come down. So that's why you want to pay attention to your volatility charts and kind of get a feel for what's the sort of texture of the volatility market. Am I paying a lot? Am I paying less? And what's the skew like? So at this point, you can continue to play upside, but it's going to be in things like call spreads. It's going to be in broken wing butterflies or maybe just butterflies. It could be in not so much calendars because you're going to have that Vega risk. So there are different things that you do in different places, which is what I get into in my courses and programs that Samantha was talking about. You want to be that well-rounded trader so that you're not like, oh, wow, I was right on this move, but I didn't make anything, or I lost money, or this isn't what I thought would happen. So it's a different market now than it was 5 weeks ago, and people have definitely bulled up. In the options market, we are seeing things change. If I look at, there's a wonderful spot gamma scanner that they put out where you see all the stocks are over to the right side, which means upside calls have gotten expensive versus those downside puts. This becomes a little bit better of a cover call environment, of a caller environment, and things like that sort of come into play a little bit more.
And in regards to the question up on top, sorry, I didn't see that. Thoughts on Schwab, IBKR related stocks. IBKR, largest brokerage platform, is much better stock. I really like this. I recommended this as a trend long a few years ago, and it's still doing awesome. Even if Pelfrey, the founder and CEO, retired, they've got it going on. So on Schwab, it's definitely different. So you've got the banking component. They had some big risk profile earlier, but for right now, just from a standpoint of, I know a lot of people have it, do banking there, but as it relates to this combo punch, if we do have some weakness in the regional banking on consumer lending slowdown that is going to flow over to the majors, Schwab is going to be susceptible. I prefer IBKR much more to Schwab, long story short. Then another one was, I already answered the question about China. Yes, very bullish. Baba and Baidu have already run. They can go sideways. We still have the threat of headline risk. JD hasn't even triggered yet. Jeffrey researched this for months. He's so fundamentally bullish on JD. It hasn't moved, technically speaking. I will tell you, if you check out the January $40 calls, JD right now is about 35. It vacillates. It was a great, don't let it go below 29, something's wrong. But basically, this 30 to 35 range, it's been ping pong, ping pong. It has over 400,000 $40 January calls. They just keep hitting it every single day.
Ooh, that's interesting. People buying, Samantha? Or
yes,
I guess they're buying.
Yeah,
what month is that?
And I'm tracking it because I have a high conviction on this, right? So anyway.
January? You were saying January, I think?
January, $40 calls. They're just peppering this thing for months. And I've been tracking this 4 months, as clients know. So anyway, long story short, it hasn't triggered yet, but yes, I'm still very bullish.
Well, look at that. Perfect example, Samantha, of what I was talking about. So that vol just came down and down and down and down for about 6 months. And then in the last month has just the option pricing. And we're talking about 1 year options. These are not things that tend to move very quickly. The tail of the dog is the front end where everybody likes to play. And that's where you get the move. So that tends to react more quickly. I'm looking at 1 year options that have just absolutely soared into what's going on. So there's Part of that is what's happening in some other ones like the BABA. So that's going to sort of bleed into JD because now people have figured this is going to happen as well, which it could. And then part of that is, I think, which I talked about a long time ago, I said, I think the realization that we're coming into a big question mark kind of market. Like, I don't know, what should things be worth in this new AI world? We don't know who's going to win, who isn't going to win, how's it going to play out? So that uncertainty has to also play in. You cannot have longer term vols trading at super multi-year lows with that happening. And I said, if I ran a vol fund, I would be all over these long-term vols. And here we go. Boom, they've come back. So now we're starting to reflect a little bit more of what's going out there. So it gets a little bit trickier. But that's interesting that they're buying those. That's gone. The option IV has gone from about 37 to 48. That is a big move.
And it hasn't moved.
Year.
Price has not moved. Trust me, I know this guy.
Wow.
So how would you play this coming in, knowing that this is massive? How would you play this if you were just coming in now, given where it is positioned?
It would be tough for me to buy those options out that far, just because if things do reset and calm down, you have that Vega risk. So there's just, by doing nothing, they may just reset lower. So you have a little bit of that risk there. Probably play something a little bit shorter term. If I really felt like this was going to go, maybe do like an upside call spread, maybe like a butterfly. So I would go on JD, I would go in and I'd say, okay, look, the vol's high here. So we can't do things the old simple way. We're not just going to go out and buy a bunch of calls. But what I would do is I'd say, okay, there's a little catch-up trade here. Potentially, would I go November? Yeah, you could go November, but let's say we went December. You could do something like it's trading at 36 bucks. So you could do a 39. Let me build this little trade here for everybody.
Okay, you build the trade. And just to answer Shan, it is 267,000 jobless claims. And we don't just tag it, we have to get and stay above it. So just like in 2007, it was 1 year before we had the great financial crisis where stocks crashed 55%. 1 year of rising jobless claims. So this is not a tomorrow thing. Even though tomorrow is Thursday and we do get jobless claims, maybe. The point is it has to stick the landing and then incrementally increase. Like, we will have an unemployment rate by 4.5% by end of this year. The Fed expects 4.8%. So they are worried about the labor market. There's no question. And they're willing to take the hit on inflation in order to support the labor market.
They are,
which Richard was just talking about. But we'll deal with this. This is a 2026 problem, but it will only grow. So anyway, build out your trade on JD.
Yeah, so it's giving me, if you did like a 30, like a 39, 45, 46, that's a little tight.
What month are you in?
I'm looking at December. Maybe like a 39. So when I do my directional flies, I don't like to just kind of have the traditional butterfly, because if it sort of blows through there, then I won't make money. We've talked about that many times. It's always frustrating when you're right on direction, but you don't make any money. So I will always pay a little more to break the wing. What that means is you don't have the strikes equidistant from the thorax, the middle of the fly, of the butterfly. If we want to get anatomically correct about the butterfly, we sort of bring that upper strike a little bit closer. And that gives us the ability that if JD does want to go to 170 suddenly, I'm looking at the wrong stock. If it wants to go to 50, if it wants to go to 170, you'll still make money, but you'll still be upset because you won't make as much as you feel like you should have.
So the last time it took 2 weeks for JD to go from 29 to 48.
Well, that's why this market is interesting to me still, Samantha. And I think I'd like a pullback now and then as much as the next guy, because I think then that sets us up for the next one. But what I'm looking for now is the options that are a little bit cheap. So I found that Micron was like that. I found that Google was like that at one point. And so where the market just kind of decides that, look, this thing is just worth, this valuation is incorrect. And we have a new realization that it should be worth this much now. And that's where you see some of those options are not, I mean, you have to be right on it, but they're not exactly correctly priced. So you want to look for things that can really, so that's really kind of the fun part of this market, is going to be looking for these potential opportunities, because like an Oklo, like it or hate it, it went from 70 bucks to 140 like that. Mm-hmm. You had a stock that doubled. Now,
or soon, right? SoundHound is another one of my recommendations. Yeah. I love this one. It has a 33% or ish short interest. It's definitely an AI middle player in software. And I did a whole review, a deep dive into 6 of them, including a Palantir. And this was still my favorite one. When that flew last October, it went from $6 to $25. And it took a few more weeks than JD, but the point is, when it flies higher than
When they go, they go. Yeah. ASTS was another one of yours, the ASTS.
I'm still in that. I think that's a phenomenal long term. And in fact, when I recommended that, it didn't even have leaps above $50, $55 strikes. Now it's got $90 strikes all the way out into 2028. So it's because it's finding a market. The option depth is getting much deeper. And that's what also happens when they get discovered. I was looking at Peloton yesterday for clients, and this is another one that I like, and it has nothing past December. So you can't even play April because it's so thin. But once it gets a few dollars higher, then they'll get discovered and it'll start to deepen. Anyway, this is a waiting game in some cases. We got a question in chat before we close. If there is a 5% correction with vol up, would that make upside calls more expensive relatively based on IV, though the price of the stock would decrease?
Well, at this point, when you get vol reacting the way it is reacting, which is kind of a little bit panicky, when you get a pullback, you're going to probably see options not take off. Sometimes you'll see that the VIX will go up with the market kind of moving up too strongly. And then when the market pulls back, it will actually relax. And so I think you could see that in some of these names. So for example, I played a downside in Rigetti, and sure enough, as soon as the thing came down, then the option started to relax a little bit. So it's a tough thing to answer because it depends. If we get a violent pullback, then you probably won't see much of a pullback in option pricing. But if it's a little bit more measured, then you'll probably see that upside just kind of relax a little bit. And then that's when you kind of get in there and get ready to reload for the next big run. And that's what's fun. We were just talking about all these stocks that can go parabolic. That's part of the reason why, like, I have people who've come to me and said, boy, I've done okay with option selling, but I feel like I've left $500,000 on the table. And I said, yeah, that's what happens in manias. The options generally aren't priced for upside crashes. They're priced for downside crashes. So when you start to bring in the possibility of upside crashes, which is part of a mania, it's part of some kinds of markets, a .com, or indeed what might be happening here, is you get those crashes. Like we're just talking about, a stock will double like it's nothing. So the upside is not correctly priced for that. So I'm not saying it's easy and that you just go out and buy like 1,000 calls across every name. But if you can kind of identify those areas and watch those charts, look for those things to start to get in. And if it's a story, if it's a rare earth, if it's a quantum, whatever, if you have a good feel for something that might be starting to move, that might be a nice way to play things.
All right. Well, I'm sorry about camera dropping out. We did our power hour nonetheless. We'll see if we get data this Thursday, Friday, and into CPI. Otherwise, yes, ADP was poor, but St. Louis Fed is a better indicator, honestly, if you're looking for some employment data that I trust more anyway. And it's the trend, not a one-off report. We are definitely weakening under the surface. And a shutdown not only furloughs 800,000 of the 950 or what have you, but those furloughs can turn into firings. And it's very clear that Trump does not worry about a government shutdown. The longest one we had was 2018, et cetera, et cetera. And he would get a lot of power over the purse in following through. So it isn't if we have a shutdown, the market's not reacting to that because it's not expected to last more than, let's say, 5 days or a week. It's if it extends, then those furloughed federal employees can turn into firings. And that's when we start to shoot up and volatility starts to come in. And that's where we're saying, be careful, don't be complacent, because this bull train can get derailed. So one of the patterns that I'm looking for is what's called a fake breakout fast failure. And so I will be looking for that. Right now, I don't see it. Is for all the reasons I keep doing my live trading room mantra on repeat. I haven't seen it yet. But we are definitely getting closer to a macro trigger, and October seasonality is always more volatile than September. So don't be complacent, and hope this helps. And we wish everyone a great rest of the trading week. We'll be back next Wednesday with or without CPI data, with or without employment data, and we'll answer your questions again then. Thanks so much, Han. Thanks, everyone.
Thanks, Samantha. Take care, everybody.
Cheers. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.